Well, traders, it's Saturday, March the 15th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you FX market wrap-up for this past trading week and an out for what we can expect in the week ahead. This past week was a very noteworthy one for volatility. Certainly a lot of provocative moves, particularly from the risk measures, including the S&P 500, which closed out the week looking like this. But this coming week has a lot more of the event risk, the triggers that we would expect to be necessary to get us into a single-minded focus on risk trends or relative monetary policy, one of those major themes that can actually drive consistency and follow through. We've been waiting for a meaningful drive for some time. And this is, once again, getting into the opportunity of actually seeing that drive develop. Now, the greater potential is not necessarily for a risk-positive move, something we've talked about on the S&P 500 as our example for some time. It's much more considerable if we had a risk aversion theme. Why? Well, because of all the conditions that we've seen support the excessive positioning and risk, whether it be record high S&P 500 or other equity indexes, whether it be the use of leverage, whether it be the exceptionally low level of participation in speculative markets, or, which has been more interesting now, the high level of exposure to emerging markets and high yield assets. All right? Whatever the measure might be, we can see that yes, the trend still points higher to these riskier positions, but the potential for follow-through is ebbing. Why would it ebb? Because we don't have the growth, we don't have the yield forecast, and we have a significant step back in stimulus and expectations for the moral hazard support that those central banks have given us for years in past. All right? Alternatively, seeing market conditions like excessive use of leverage and a lack of participation and a one-sided positioning that turns awry. Those are the types of circumstances that can in turn lead to a very concerted and kind of waterfall effect unwinding. All right, so risk aversion, far greater potential but not necessarily greater probability. We have to match potential and probability, and when we have event risk like we have in the upcoming week, we can finally potentially stir that probability and turn it into reality. So in terms of looking for risk, I think risk has one of the greatest overriding influences, if properly motivated, of any other aspect of the market. So we have to always be on our lookout for that major catalyst that can turn a consecutive risk theme, whether it be driving U.S. or Asia or European equity indexes, or more likely all together, because look at these things. They are just all at very remarkable technical levels. Nikkei 225, the German DAX, the US S&P 500, all very meaningful levels. Or we could be talking about yen crosses. All right, these yen crosses are not necessarily at the very threshold of those bigger moves, but we know that they are very close. All right, euro yen. If we get that turnaround, that would be an unwinding of carry trade, which is the FX version of risk trends. And we also have the emerging markets. All right, dollar-ZAR is a good standout, but we have been monitoring pretty consistently the participation or the influence of the entire emerging market sector itself. You can see this is the MSCI Emerging Market ETF. So we'll use these as our gauges, our benchmarks, and we want to see all of them respond as we would expect to risk trends. And to see that, we would expect it, as it moves up in amplitude, we would expect a much more substantial movement. Not just the initial drive, not just the first blush of volatility, but follow through. Follow through. That's what we've been looking for. That's what we've been waiting for. So what on our docket is going to be immediately concerning? Well, we know over the weekend there is going to be very substantial event risk in the form of the Crimea referendum vote. All right, this is a vote for the region that's taken by the regional parliament, or whatever their official designation is now, to decide whether they want to join the Russian Federation or stay as part of Ukraine. All right, now of course there are very taut deliberations between both sides that are supporting the different groups, the different factions. You have Russia essentially on one side and the West, Europe and the United States on the other. These two are very important global participants. All right, the BRICS and the developed advanced nations. We need to have those countries working in harmony if we want to see the continued rotation of capital from risk in one region to another. If we break or disrupt that flow, you have a risk aversion theme and an unwinding of exposure where investors will not just move their risk, let's say, from emerging markets into riskier assets in the developed world. They're more likely to remove their exposure to that emerging market asset and also just continue down the line and put it in something safe haven. All right, so it sparks a more dramatic move towards risk aversion. So this is not necessarily the be-all, end-all of this situation. We'll see if this referendum, this vote goes through. It is still tentative, but you will see continued talk about this particular event and how different countries are going to respond, like the EU foreign ministers meeting on Monday and talking about the necessary sanctions that they may take given the situation. All right, this is going to be a fluid situation. We know, and as I've said before, that when it is lacking detail and definition and it's not clear how it can materially impact the markets through all the various scenarios, it carries with it much greater risk. All right, so we will watch this referendum very closely and see what it leads to and how it impacts, very importantly, the capital markets. Now, when we look at risk trends, it's not going to just be about what's happening with Ukraine. We need to look in general at the other conditions that are behind us. Now, we know that the Ukraine is not the only issue. We just looked at market conditions that are themselves something to be extremely concerned about. Excessive leverage, excessive exposure to riskier assets. Why do we take that exposure? Why did the market take that exposure more appropriately? Well, because they presume that there would be little risk on their part because they have backing. They have what we call moral hazard, central banks ready to step in to prevent a very substantial financial market unwinding. All right, those expectations are starting to ease, however. We'll talk about that in just a second. But is the presumption that there is low to little or maybe no volatility or risk in the market, which we see here, and subsequently with this exceptionally low or accommodative policy stance from central banks, we've also had extremely low levels of return. So investors have to use that leverage. They have to go to something that is quote-unquote risky if they want to make a meaningful return, especially if they want to beat something like the S&P 500, which is extremely difficult to do. So they are driven to those exposures on the same policy that helps to stabilize or aims to stabilize the situation. Now, these expectations have really started to fall apart as of late, not necessarily to the point of sheer risk aversion, but we have started to see a consistency in uncertainty. And that's where we're starting to witness a pickup in volatility. That's where we're starting to see some of these markets are tentatively pulling back. Now, in this retreat, all right, if we need evidence or we need justification, fundamentally speaking, of why these would continue, we have plenty of it. We can talk about China and its economic slowdown. Data this past week was very disappointing. All right, we do have a couple of indicators that are on the docket for China this coming week. Not necessarily the big market movers, but something like property prices links back to the credit market, and we know that the credit market squeeze that's happening there, and the now very real defaults in the country are going to carry some substantial influence, substantial risk. All right, we can talk about U.S. growth slowing substantially. Not necessarily to stall speed, but leveling off to the point where it's not just a grab all for returns and expect them to be met with strong revenue. We can also look at central banks. As I said, we've had a number of central banks that are backing off on accommodative policy. whether we're talking about the Fed, which we'll talk about in just a second, on Wednesday, their rate decision, whether we're talking about their taper, whether we're talking about the ECB and their refusal, not this past week, but the week before, to actually expand their stimulus effort. And we have subsequently seen, in turn, their stimulus or their central bank balance sheet has substantially declined. All right, there we go. Or whether we're talking about the Bank of England, who is now on the way to potentially rate hikes, the Bank of Japan, who was previously expected, almost a certainty amongst market participants, to increase their stimulus, right, their open-ended QE program. But as of late, we haven't really seen any kind of threats along those lines at all. They keep open the option, but they are not guiding the same level of expectations that they did previously when we were going into the 2013 April rate decision, in which they fulfilled the open-ended stimulus dream. All right, dream, goal, fear, whatever you want to, however you want to look at it. But we can see that the markets aren't expecting the same thing. There is doubt, serious doubt, that is going into this particular April fiscal new year time frame, where we expect that stimulus program to occur. So we have a definitive and broad shift away from easy accommodation and is starting to turn to neutral, and subsequently there's even some early talk of hawkishness. Right? Whether we're talking about the RBNZ, who is on the path to rate hikes already, or the Bank of England, who the markets believe is very close. Right? All of these are major factors that are changing the underlying foundation of what we're trading. Right? And they have very real implications for the risk that traders are willing to take in the positions that they hold. Now, it might not lead to an immediate collapse, because we recognize these factors doesn't make them all of a sudden market moving, but they will feed into that eventual deterioration, that eventual turn. It really depends on the catalysts. That's what we have to look for. We have to get the right catalyst that can escalate us up this severity curve. If we can hit this or higher, or if you will, these are the different asset classes that would respond to it. So if we can get all the equities dropping off and treasuries responding as a safe haven asset, if you have the pound dollar starting to act like a risk currency, a risk reward currency pair, and the US dollar is a pure safe haven, right? That's when you have the kind of influence necessary to start momentum. All right, we have to get above that. We have to get not necessarily to the point of financial squeeze concerns, credit liquidity concerns, but we do need to get above this level and stay there a little bit. That will jumpstart this engine. Right? In the meantime, it's not just about risk trends. We also have to keep a very close eye on monetary policy considerations over the coming week. These are going to be actually exceptionally important, especially in between or in the lulls of the risk updates. The Euro-USD is perhaps one of the most interesting currency pairs for us, because we're talking about a very specific monetary policy forecast. We're talking about, on one side, the ECB, which is accommodative, but they refuse to give more stimulus that the market itself is expecting. We've seen the World Bank, we've seen the OECD, we've seen the IMF all suggest that the ECB should do more in terms of stimulus and also cut rates or cut rates. Now, this has a very negative connotation to the euro. It's bearish, but as you can see, the ECB has not followed through and the euro has not dropped. So what's keeping this euro elevated? Because while the ECB is not necessarily working down its policy, neither is the Fed. The Fed is actually engaging in taper, and that is itself a modest shift in terms of accommodation towards austerity. So it should balance out, but that isn't the only factor here. We have seen that there is and this has been a pretty under the radar story relative to other things, and that is that there is a move of capital, or diversification of capital, especially China, away from the U.S. dollar and treasuries, and China itself and Japan and a couple of other very prominent large cash holders are putting their money back into the Eurozone. Now, this is the same kind of circumstances for which we've seen the capital flow into Spanish and Italian government bonds. These are yields, government bond yields, flipped upside down. All right. This is, in other words, the level or rate at which they lend or borrow is at record lows. All right. And this is driving the euro higher because that capital is flowing into these periphery countries. Now, remember, Spain, over a 25% unemployment rate. Italy, huge debt load, the largest in the eurozone. We just, this past week, saw Ireland's fourth quarter GDP was a surprise and shockingly large contraction. It was expected to grow. And the Italian 10-year government bond yield is at a record low. All right. These are capital inflows. These have the same qualities, and this investment has the same quality as what we're seeing as an investment in high-yield assets, emerging markets, and on leverage. Right? Investors are trying to seek out that higher rate of return. There's also a diversification element from it, like we see with China, but there is also a very hefty speculative additive added to it. So that makes it much more flammable and exposed to the potential of volatility. In other words, if volatility were to kick up and we were to see our more traditional asset classes like the S&P 500 respond as we would expect, with risk rising, volatility rising, and the S&P 500 pulling back, so too would the capital flow out of something like the eurozone. All right, so this added a very risky element to the euro. Perhaps the ECB is standing back because they expect this, let's say, not bubble, but this elevated position to unwind a little bit. Okay. Otherwise, we're also going to see that the US dollar is going to be perhaps one of the most speculated on relative monetary policy groups for this week, or monetary policy positions. So the euro is getting that steady, quiet bid. This Euro USD can collapse easily enough if there is a risk aversion theme. If there is a risk aversion theme, watch that 138 level or 138.25. It will be a good signal that if it comes alongside of selling in other risk assets, that would be a very good indication of that more dramatic pullback that could potentially take place. But we can look at the dollar in other places as well, not just the Euro USD. We can look at the dollar potentially gaining ground here with against the pound. We can see it potentially gaining ground with the Aussie dollar, or against the Aussie dollar if it does pull us back from that inverse head and shoulders neckline, and potentially even, as long as the risk theme doesn't really pick up, the dollar can gain significant traction against the Japanese yen. We need to be watching the FOMC rate decision on Wednesday. Now, there are other indicators and other event risks related to the United States over the coming week, including CPI. We have the net TIX flow, which is going to come out, I believe, on Monday. International capital flows, the TIX flows on Monday. That's going to be important because what we're just talking about, China diversifying, we'll see more of that or less of that in this particular figure. Lots of data, but we really need to focus on this FOMC decision. Why? Because it is the quarterly event where we will see updated forecasts for growth, inflation, and interest rates. We'll also see for the first time the press conference from new chairwoman, Janet Yellen. She will give us a read on what she sees for monetary policy going forward and how she will conduct this symphony of monetary policy and the potential exit. The expectation, the leading expectation, is for ongoing taper. All right, but there have been calls from speculators to stall so that you can support markets. There have been calls from some policy officials who say that there might be a need to accelerate the taper, which would probably not be very popular. But this can change, and what we're really looking for is the inevitable time frame for rate hikes. All right, it's not going to happen in 2014, most likely, although there are a few Fed officials that think that this might happen. There is amongst the primary dealers, which there's a survey that the Federal Reserve of New York does before each rate decision, which they use to assess what the market is positioning for. They think there's a number of those market participants that think that they could hike in 2014. But it is not the running consensus. The running consensus is mid-2015. All right, that's still a ways off, but where is the Bank of Japan and its relative positioning for rate hikes? Where is the Bank of England? Where is the Eurozone? All right, these are relative positions, and markets start to price these conditions in very early. They don't wait till the last minute. They don't wait till the actual rate hike itself. They price it in well ahead of time. Just look at the New Zealand dollar and how much ground it gained well before we actually got to that rate hike. All right, look how much ground it gained against the Australian dollar. These are forecasts. These are forward-looking markets, and they will certainly move on these much bigger conditions. All right, so this FOMC rate decision is going to be particularly important. It will be kind of a midweek break from certainly a market that will be obsessed and anxious over risk trends, but it is standing as one of the most prominent releases. Now, this is not the only monetary policy group. We just talked about the ECB. We've talked about the Fed. One thing to be watching out for the ECB, though, as an aside, if there are any more comments from Draghi, if there are any more comments from Draghi or any of his policy cohorts, his colleagues, then they try to talk down the euro. In other words, that could be a major driver for the euro. We've seen him attempt to talk down the euro this past week. It did push us back from hitting that 140 level, but it didn't really get us going in the opposite direction. It just led to a pullback. All right, so we'll see. There are a number of scheduled speeches if there is something more that they plan to add. We'll also look at the Bank of England. All right, the Bank of England is on deck for a couple of very important pieces of event risk, and that includes the BOE minutes and the UK job claims. All right, this happens on Wednesday as well. We need to watch the pound because they are sitting on very excessive interest rate expectations. They are known historically as being one of the more aggressive policy changers, whether it be hikes or cuts, but they're more prone to hike in aggressive manners. So the market is willing to sit with some of that premium. But if we see things that undermine those expectations, which they have been as of late, then it could potentially shift the expectations here. It can shake the market loose of complacency, especially if we're talking about a risk aversion theme, which undermines just a sitting on yields, especially sitting on yields with forward intentions. All right, the Bank of England will certainly be something that the market weighs in on this coming week. And you can also watch for a scheduled speech by Bank of England Governor Mark Carney, who will be talking about the Bank of England strategy review, which he had an outside consulting firm look over. So we'll see if that leads to any substantial changes we should take note of. We should also be watching a couple other central banks, although they will not have that major update. Well, one will. The Bank of Japan, as I noted before, is moving away from a almost fully priced in stimulus upgrade. All right. The market is really starting to doubt at this point that the Bank of Japan will automatically put that stimulus program update into place. Well, coming up this next month, we have a tax hike in Japan, which is expected to significantly undermine growth in the second quarter. We also have some evidence that the inflation that Japan is targeting, while they say they're slowly reaching their goal, and most of it is in a rise in energy prices and fresh food prices. We're not seeing the consumer inflation and the wage growth that they would want to come along with it to be a sustainable and healthy inflation growth. So one comment that we highlighted this past week was one of Japanese Prime Minister Abe's aides had suggested that the Bank of Japan could increase its, or the stimulus effort could be increased to double its size if need be. All right, these are the kind of comments that the market will be looking for. Otherwise, if we just leave the yen crosses open to risk on, risk off kind of flows, we're in a very real risk of seeing these yen crosses drop to very, very substantial reversals. All right, because most of them are standing very close to the edge of multi-year trend lines. All right, particularly the dollar yen, the pound yen, and the euro yen. These are risky exposures, and they certainly have their connection to risk trends. If we start to see these fall off, these are opportunities we want to take advantage of, but also be aware of the possible effort by the Bank of Japan to stall or stymie any kind of declines of that magnitude. They won't be successful, but they could try. So keep that in mind as well. And one currency that we don't really talk about all that much because we don't really have a need to, that we need to pay close attention to in the coming week is the Swiss franc. All right. We have seen the euro Swiss slowly march down. All right, and they are coming. We are getting pretty close down to this enforced floor by the Swiss National Bank at 120. Still at 121.40, so we still have some room, but the fact that we haven't been able to get the euro Swiss moving higher and stay moving higher is probably of material concern for the S&B. All right, they are trying to prevent their currency from appreciating too aggressively and thereby significantly impacting their exports and hurting their economy. All right, this is a persistence pulling back to this mandated level here. Despite the fact that they have started to cut off the financial flight into the country, it's much more difficult to harbor your capital and hide from tax authorities in other countries nowadays. They've also seen the euro rise steadily against the U.S. dollar, but it's not doing so against the Swiss franc. All right, this is certainly of concern for Switzerland, and we do have a Swiss National Bank rate decision that is on the docket next week. Normally, I would say this is probably not going to lead to anything, all right, but this might force the Swiss National Bank to do something about it, and whether that means some kind of increase to the floor, which will probably have limited impact on the exchange rate itself, whether that means introducing new capital controls, negative interest rates, because if the European Central Bank has to consider and entertains the idea of a rate cut, they're going to have to do something to help offset that. But even before the ECB acts, there are very real problems here for the Swiss National Bank. So this is going to actually be another interesting monetary policy update that we're going to get during this very, very busy week. Now, there's plenty of other event risk on the docket. We've seen a lot of risk-based trends, and we've definitely seen some big moves from the commodities market, including gold and including oil. We're going to continue to see this going forward because these are conditions that are not necessarily resolving themselves. They are actually building in terms of intensity and uncertainty. These are the kind of markets we like to trade. All right? It creates difficult positions. All right, you have a lot of possible volatility events that we don't know how the volatility will take, but we know that there is some asymmetrical opportunity, more towards risk aversion and the potential therein, rather than positive risk trends. We know that the bearing or the lean is towards risk positive, but the potential, if you see big volatility events, more likely to be risk off. All right, we can use that to our advantage, but keep your positions relatively low risk. All right, that means low leverage, low exposure. Make sure your stops are forgiving, but your targets are also reasonable. Keep these rules in mind until you actually see meaningful trend development, and fundamental and technical. All right, when you see those conditions change and support a bigger move, that's when we can start to really position for those bigger moves. Until then, we have to remain flexible. Keep your eyes on these markets. These are not to be turned away from, and you don't want to just have a position that you set and forget. You want to make sure that you're watching the major event risk and participating, because these are great opportunities. They're also exceptionally risky. Keep that in mind for next week and make your plans for next week. But in the meantime, I hope you have a fantastic weekend, and I'll update you once again on the FX markets next week.